Imagine you run a hardware store. You buy 50 boxes of nails from a local manufacturer, pay the cost of the goods, add the required goods and services tax, and file the paperwork. You've done everything exactly by the book. Because you paid that tax on your supplies, the system grants you an input tax credit. It's a standard deduction you claim against the taxes you collect from your own customers, keeping your profit margins intact. But then, a hidden gear in the machine breaks. The manufacturer who sold you those nails takes your tax money and simply pockets it. They never remit those funds to the government treasury. Even though you paid the money in good faith, the government reacts by denying your tax credit. You are forced to pay that same tax amount a second time, entirely out of pocket, absorbing the financial damage of a crime you didn't commit. This exact scenario has played out across the country, prompting thousands of outraged business owners to file petitions in the courts. Their legal fight zeroes in on one highly contested piece of legislation, Section 16, Subsection 2, Clause C of the Central Goods and Services Tax Act. Looking at the court documents, the formal complaint reads this provision as arbitrary, ultra-virus, and violative of Articles 14, 19.1g of the Constitution. The argument is straightforward. Penalizing a bona fide purchaser for a supplier's default is a denial of basic fairness. This sets up a collision between two opposing priorities: the protection of an innocent citizen against the strict enforcement of a national tax code. To understand the government's defense, we have to look back at the historic rollout of the GST itself. It was a precarious balancing act of cooperative federalism, designed to unify dozens of competing state economies into a single market. To keep that market from collapsing, the system relies on one absolute rule, found right in the drafting documents. The availability of a tax credit is intrinsically connected to the factum of taxes paid. Under this logic, an honest paper invoice holds zero value. A credit can only exist if the actual cash has physically landed in the state treasury. Let's run a stress test on the petitioner's demands. What actually happens if the courts strike down this rule and allow innocent buyers to claim their credits anyway? Normally, the originating state collects tax revenue and transfers it to the destination state. If a fraudulent supplier intercepts the cash, the originating treasury remains empty. Yet, the originating state is legally forced to transfer money it never actually collected to honor the buyer's credit. The court's judgment models this exact scenario. It warns that states would have to transfer the amounts it never received, causing loss to the tune of several crores, rendering the whole GST scheme unworkable. Relieving the burden on a single honest buyer creates a mathematical black hole for the government, forcing them to pay out phantom taxes until the state treasuries are completely drained. Lawmakers call this mechanism self-policing, a deliberate design choice built into the tax code to prevent revenue leakage. By making the buyer liable for the supplier's default, the law forces the free market to regulate itself. Every purchasing dealer now has a direct financial incentive to verify the honesty and tax compliance of anyone they do business with. The business owners argued that claiming a tax credit is a constitutional right protected by law, but the state counters that building a functional, leak-proof national economy requires turning every private transaction into a localized checkpoint for tax enforcement. The courts ultimately sided with the state. The legal text clearly defines this boundary, stating that an input tax credit is not a vested right, but a statutory concession, strictly subject to the conditions prescribed under the Act. The buyer isn't left entirely without options. The Revenue Department maintains the power to initiate recovery proceedings and hunt down the fraudulent supplier who stole the funds. Once the state successfully recovers those missing taxes and deposits them into the Treasury, the buyer's statutory credit is immediately restored. The highest courts have upheld this intricate, unforgiving framework because of what is at stake.